Hello, chart watchers, and welcome to this Wednesday, March 28th Market Watchers live show with your hosts, Tom Bowley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, the NASDAQ has been struggling of late, and it is continuing today. First, let's take a look at the Dow Jones. You can see the Dow Jones up 25 points, the S&P down 2, but on a relative basis, the weakness is much more prevalent on the NASDAQ, where we're down 43 points today. The Russell 2000 also near the flat line, but is down fractionally, down at 15.12. 10-year Treasury yield. This is big news. We had been in a sideways consolidation for the past 5 or 6 weeks. Yesterday, we closed below support at 2.80%, and we have continued that move to the downside, trading now down at about 2.75% on the 10-year Treasury. Volatility index continuing to move up, trying to challenge and break out above the 25 level. That is not good news for equities as fear picks up. Many times we see the sell-offs really accelerate. The XLP, consumer staples, best performing sector. The XLY, consumer discretionary, is the worst performing sector, and it is down at a key support, testing the early February lows. The broadline retailers, a group that really we haven't seen much selling in this group over the past probably 16, 17 months, but we have seen that selling since early yesterday morning. We were trading over 1650. Early yesterday, we hit 1500 today, or got very close to it. Again, challenging that February low. Lululemon, LULU, reported earnings better than expected, making a significant breakout. BlackBerry and Walgreens Boots Alliance, both of these companies also posted positive results, top and bottom line, but they are not receiving the same warm welcome today. And with that, let me bring in my co-host, Erin. How are you doing this morning, Erin?
I'm doing quite well, thank you.
That is awesome.
Day.
It is. It's actually supposed to get up in the 70s here in South Carolina. Believe it or not, spring is trying to finally arrive.
Oh, high five. That's about what I'm expecting today, too.
Well, on Friday, I'm leaving. I waited way too long for the spring to arrive. It wasn't coming, so I planned a trip to Florida. So I'm heading to Florida on Friday, where it's supposed to be 80s, in the 80s for over a week. So can't wait to get into that. But speaking of, warmth, we have a great guest with us today. Certainly, Erin, you talk a lot about sentiment. Well, we have Mr. Sentiment, Mark Young, with us. How are you doing today, Mark?
Real good.
So good to have you on here. I know you've been with us once before, but I think the volatility has picked up quite a bit, and the market moves back and forth have picked up quite a bit. So I think your presentation will be very timely today, and we're going to do that in about 15 minutes if you'll hang around with us.
I'll look forward to it.
All right, and with that, Erin, I know we got a busy schedule ahead, but let's jump into the announcements and the agenda.
Oh, yes. So tomorrow we do have Arthur Hill coming on the show. That'll be great to talk to him. Friday, yes, the market is closed, so we won't be having a show on Friday. And if you were here yesterday and you would have heard the big announcement, Stock Charts TV is going to kick off on Monday, starting with our show 24/7 content on Stock Charts TV on Monday. So that should be very interesting.
I don't know when you're going to sleep, Erin.
I know. I'm trying to figure that out too.
You're going to be on 24/7, right?
Right. I know. With you alongside of me.
Oh.
Coffee. So for today, we have Mark Young, of course, as we said, to start off the program. 10 and 10 to 1. Our first stock symbol is going to be Roku. Pretty easy. Roku company, Roku symbol. Scooter report will finish off the afternoon for you. And with that, let's go right on into some technical news, Tom.
Yeah, it's there's some things changing in the market. There for a while it's pretty kind of boring with the 10-year Treasury yield. We kept talking about it consolidating for a while. Well, after going back up recently, a little over a week ago, and challenging the upper end of this range, we have seen the 10-year Treasury yield continuing to decline. It's been down for the last 5 days. It did break below the support area, 2.80%, and is currently down about 2.75%. Got a couple of economic reports out earlier this morning at 8:30 Eastern. The final Q4 GDP came out. It showed that it had risen 2.9%. Market was expecting 2.7% rise, so a little better than expected there. And then February pending home sales came out at 10 a.m. They rose 3.1%. Market was expecting 3.0%, so a slight beat there. But I should mention that January was revised lower from a drop of 4.7% to a further drop of 5.0%. So not such great news there with the pending home sales. But you can see the 10-year Treasury yield, this range that I had kind of been expecting for a while, because you could see that the PPO had rolled over. We had made a huge move up, so it just made sense that all those folks that had been selling in treasuries, we got very oversold in terms of treasury prices. And so we kind of expected maybe a little bit of a rebound there, which would show some sideways consolidation in the yield. And that's exactly what we got. But we did break down yesterday, which shows that treasury prices are breaking out, and that's a defensive area of the market, the treasury market, bonds. And so that is never a good thing when you start seeing the yield break down. Now, this is a short-term chart, and kind of like the overall market in the past 2 months, we're in my opinion, we're correcting in the market, but we shall see whether or not that turns out to be the case longer term. But it wouldn't surprise me to see the 10-year Treasury yield on this breakdown now go back and test the rising 20-week moving average, which it had been has been above for quite a while. Here is the weekly chart on the 10-year Treasury yield. Here's the weakness. This is all that consolidation that we just looked at on the daily chart. When you look at a weekly chart, it kind of brings things into focus a little bit better. After you have big moves up, it's not unusual to consolidate, although I don't expect to see several months of movement to the downside. I think the economy at this point has shown enough signs of strength, and the Fed has talked about the strength. So I wouldn't be looking for a lot of movement to the downside, but I certainly think now that we've lost 2.80% support, that a trip to test the rising 20-week moving average, which is just below 270, is certainly a possibility. We saw many tests of this same moving average back in the fourth quarter of 2017 before we had another breakout. So that's what I'd look for next in the 10-year Treasury yield. But of course, that short-term movement in the Treasury yield to the downside can have a negative impact on areas in the stock market, especially the financials. And the XLF is the ETF that tracks the financials. And you can see that over the course of the last week, when we've been moving down with the 10-year Treasury yield, the financials have moved down to test the lows that we saw back in early February. I wouldn't be surprised if these give way to the downside. And if that's the case, could even see maybe 25 and 3/4 to 26 come into play. That's where we had some support on the XLF back in October and November. I do want to mention in the blog today, I posted a number of things, and rather than try to recreate them, let me just pull up my blog. I don't know if you realize this, and I was kind of surprised myself, but the last 4 days on the NASDAQ, when you look at it, we lost on Thursday 2.43%. We lost that same 2.43% again on Friday. Then on Monday, we rose 3.26%, and then Tuesday, we fell 2.93%. 4 days in a row where we either gained or lost more than 2%. What was really interesting is I looked back in 2017, and we only had 3 such moves the entire year where we moved up or down 2% in a day. And the 2 down days I went on further to talk about. May 17th of 2017, we lost 2.57%. August 10th, we lost 2.13%. But what was notable in each of those cases, look at where the volatility index had closed the day before. The volatility index was 10.65, very low reading back in May of 2017, right before we had that down day. And in August, even the summertime, when the market tends to be weaker, and we do see spikes in the VIX in the summer, we tend to see more spikes in the VIX because of that weakness in the summertime. The VIX was at 11, still a very low reading. So, I always talk about the market environment. That's one of the things the VIX tells me is what kind of market environment. What are market participants expecting? Because the VIX measures expected volatility. And back in May and August, you can see the VIX readings were very low. And as a result, the market rebounded right off of those weak days and really didn't look back. And both of those created lows that the market then moved straight up off of. We're in a different environment right now. And even though I still believe it's a correction, not a bear market, because we have an elevated VIX and VXN, which tracks the expected volatility on the NASDAQ 100, because we have such an elevated reading on the VIX right now, we're in the mid-20s. Compare that to where we were less than a year ago in May of 2017 when it was at 10 and change, and in August when it was at 11. The market wasn't expecting a lot of volatility. And when the market's not expecting volatility, it tends to handle bad news like it never really even happened. It just goes, market goes down for a day or two, and then we go right back up. But we're in a different environment now. I think this is important. I'm going to pull up the VXN. We always talk about the VIX, but the VXN is the volatility index for the NASDAQ 100. The VIX relates to the S&P. The VXN relates to the NASDAQ. And I did this long-term chart for you to give you an idea. Throughout this bull market, since 2009, we've been going higher. The VXN tends to move up into this 30 to 35 area. And when we get up there, if you note, the selling tends to hit a climax, and then we start moving back higher again. So you can see back in the second quarter of 2012, the VXN hit 30, the NASDAQ 100 bottomed. We get to the early fourth quarter of 2014, the VXN hits 30, the NASDAQ 100 bottoms. And then the same thing occurs in 2015 in the third quarter, and then early in 2016, those two key bottoms came with the VXN moving into the 30s. The February low that we just saw on the NASDAQ 100 occurred when the VXN went up in the 30s, actually went above 35 briefly. Right now we're at 32. So I just want to point out that normally in bull markets, when you get the VIX, or in this case the VXN, rising above 30, that's when the fear is elevating and we tend to print bottoms. Now, I'm not saying that we're at a bottom right now. I'd like to see a reversing candle. I'd actually like to see the market really get scared intraday and then have a big recovery end of day. And I think that would help to perhaps set a bottom. And maybe that's what we're doing here, although I would prefer if we actually came down below this bottom. I think this is a very significant price support now on the NASDAQ. This is the NASDAQ composite, not the NASDAQ 100. Maybe I should show the NASDAQ 100 since I'm looking at the VXN. But really, we're looking at the same kind of chart. Now, I want you to note a couple of things. First of all, the NDX broke out above the late January high. We didn't see that on the Dow and the S&P 500. So in my opinion, when you set new highs, that brings the prior low in focus, because that becomes really important as far as I'm concerned. I want to see this hold, because as long as it holds, I'm still in a pattern of higher highs and higher lows. So I think as we get closer and closer down to the 6,300 level, that's the lowest close we've seen on a daily basis. I think the closer we get down there, the better the reward to risk is if you're looking at perhaps trading the QQQ, which trades which mimics the NASDAQ 100 index. So that's something to consider there. Let's see. Going back, I want to go back in and take a look at that blog article again. I did mention it's in there. I thought was really interesting. Here was the 30-minute chart on the NASDAQ. You can see the selling. When you get a high VXN reading or a high VIX reading, you can see, and we have seen, the selling absolutely accelerate and explode to the downside. This is what happens when the market is expecting a lot of volatility and there's a lot of fear in the market. I always say market makers go on vacation. They provide liquidity, but it's not like they're buying at any cost. They know the market's fearful. They know that the selling can escalate quickly, and I certainly wouldn't be forcing my I wouldn't be looking necessarily to commit capital seeing this kind of movement to the downside. Mentioned Facebook recently. I've really grown somewhat bearish Facebook. I don't like the way it's traded. I think the volume has been extreme. I think there's a lot of distribution taking place. And I know when we were talking Wyckoff with Bruce Frazier, I think he mentioned Facebook as one that he was very bearish about, and it's proven true. It's been proven true here recently. I think Google is the next one that's in a really key area of support, as you can see. Many tops coming across around 990 to 1,000. We finally broke out on very heavy volume in October. And notice these pullbacks have been right into this area as well. So I think Google is going to be one to watch. And in fact, you can click on these. You can get a live version of what's going on in the chart. And you can see right now that we are up 12 on Google, but we did go down as low as 984. Down testing, maybe even a little bit below these recent lows. So Google could be trying to reverse here. Wanted to mention that. And last thing before we get into upgrades and downgrades. Whoops, I didn't want to go back that far. I wanted you to take a look. I also had put in a chart of the Dow with a possible bullish wedge. Remember, I'm thinking correction. I'm thinking bullish tendencies. If you're bearish, then you may look at this and say it's hogwash. But I'm not. I believe that we're in a correction. So I'm looking for patterns that confirm that belief. I think we could be setting up in a bullish wedge off of this huge uptrend that we saw in the Dow. And then the historical tendencies for the FANG stocks over the next 2 months. I just wanted to point out that is in the blog if you'd like to take a look at that. And then now let's go over to the upgrades and downgrades. I wanted to just mention one upgrade before I turn it over to Erin, because it was TNDM, which was one of the stocks that I covered yesterday in the 10 in 10. And I talked about a gap resistance level to watch. And I think Tandem is right at that area. Look at the volume coming in. I think this is a big day for TNDM. Talked about how it looked like it was probably making a run for gap resistance, and the question was, could we get through? Well, we got a lot of volume, so I think it's really important to see where this stock closes today. This could be a breakout above a key resistance area, or failure with a tail above could mark a short-term top and maybe have another trip back down to test that rising 20-day. And with that, I'll turn it over to Erin for a couple more upgrades and downgrades.
All right, let's take a look. Alrighty. We have one downgrade and 3 upgrades. I actually did a weekly chart on AT&T to look at that when we get to it. And let's start with the downgrade, Synchrony Financial. And I was looking at this one, and I think there's some bad news and good news. It's one of those situations. We had the double top, it executed, and the minimum downside expectation would have been right around 31 down here. And it hasn't had to go and test that level. It does look like it wants to head back up, but we do have some strong overhead resistance here for this upgrade. Can also see the scooter has been trailing lower, so we'll have to see if this upgrade can do something for Synchrony, but I think that is an area of the market that is going to be struggling if we continue with this correction. AT&T was an upgrade, and we can see I'm watching all of these double top formations, and I was calculating minimum downside targets. And again, you know, the downside target would be right about here. It didn't have to go all the way down to test that, and it is heading back up. You can see the PMO is starting to look better. Still, I'm not happy about these trailing off scooters, but I think if you were to draw a declining tops trend line on that scooter, you'd see a small breakout there. And I wanted to show you the weekly chart on this one. There we go. Because I was looking at a possible, you know, reverse head and shoulders, a rather complex, albeit, as they say, but you can see this very strong area of support, and so far it is holding that area. I'd be a little concerned about this PMO that is topped just above, a hair above the 0 line, and is heading back down. But the upgrade might provide an opportunity, and it looks like on that daily chart we might be getting a bounce. Unilever, we have also as an upgrade, huge gap up on this announcement. I was looking at that breakout, a very, very nice breakout when you look at that overhead resistance that's formed right there. And at this point, you know, it's up over 4.25%. I would look for a pullback to the breakout area here to that support level at about 55. Just I would look for it to go down there a little bit toward that breakout point, and then probably head back up based on this beautiful PMO bull kiss here. We got that almost, as I say, almost crossover, and then we're seeing it rising now. The rising bottoms are confirming with the rising price bottoms. Look at that very nice scooter as well. Finally, Verizon Communications. It's in a declining trend channel, but you can see the PMO, it rather slightly has rising bottoms at this point. You can see the scooter is improving nicely as well, and that is a positive divergence with price bottoms at this point. However, I'm seeing this area of overhead resistance is pretty strong. We'll have to see a breakout from this declining trend channel, And it also has some pretty serious overhead resistance around 49, 49.50. So this is one I probably would wait out for that breakout, but there is some promise here. And with that, I am going to turn it back to you, Tom. I know we have our very special guest here, and I will let you introduce him.
Yeah, we've got Mark Young with us. I do want to say, first of all, I think it's perfect timing because we have had such volatility in the market. And Mark does, as you can see, he's President, Director of Research for Wall Street Sentiment and is also publisher of the Wall Street Sentiment newsletter, specializing in investor psychology and technical analysis. Mark, it's great to have you on the show today. I know you've got some great information for our viewers. And, with the volatility up where it is currently, we haven't seen this in quite some time. The back and forth action, these huge moves, as I pointed out earlier in the show. What do you make of all this in terms of sentiment? I mean, do you think that the sentiment, I guess maybe, let me just let you go ahead and do your presentation, but I've got some questions, but maybe you'll answer them before the show is over.
Yep.
Well, maybe, actually, listening to your earlier discussions of volatility, while you say you're not much of a sentiment guy, you're looking at a very key element of sentiment right there in the implied volatility. And that tells us a lot. I think about the attitude towards the market, as well as maybe some motivations for future moves in the market. I've got a view of sentiment generally, where we want to look at opportunities for maybe smart money to exploit overexposure amongst the less sophisticated investors, or investors who are trapped in a situation where perhaps they've got a margin call or something like that. But this volatility that we're looking at here, I think, is symptomatic probably of a couple things. One is perhaps a bit of regression towards the mean with regard to the VIX. If you, and many people will remember rather clearly, there's been kind of an explosion in derivatives on the VIX. There are a bunch of ETFs out there. The inverse ETFs on VIX were doing quite well until that little shellacking we took. That was a little bit painful, I imagine, for people in there. It was a huge move. But I think that might have been, kind of a contributor to the volatility we're seeing. It's hard to know exactly how people are running a program, but there's always, when you see high volatility, that's implied volatility, and that's excess premium in the options premiums. When you see that, there becomes a low-risk trade that you can do by buying the underlying and doing a series of hedges, where you can essentially, particularly if you can push the market around a little bit, trap a lot of essentially free money. But in the interim, that can cause all sorts of strange aberrations in the market. I think that way too many people who didn't really know what they were doing were way too short the VIX. They're betting on the VIX declining to zero, or every spike being something to short. And as a result, I think that a whole lot of people got caught behind the 8 ball. And what we saw in that massive spike is simply the people who got caught wrong-footed putting a risk premium into all their options selling. For what that's worth, I think that's an important thing for us to be looking at here going forward. It might be something, the marker we want to see for a low of maybe serious importance. Near term, you can trade with volatility or against volatility. It can be a tricky thing. I think it has to be contextualized. I prefer generally to look at it as a motivation, if you will. I like to see motive for a big move. If you imagine yourself with, just for fun, imagine yourself with billions of dollars to deploy as a large institutional manager. you know you have to put money to work in the market. It's simply your job. Every day you've got to put money into the market. If premiums are high, however, that might be a bit of a motivation to perhaps save up a little bit of buying power for a period, and then say short a bunch of puts, index, or individual equities. It doesn't really matter, wherever the premiums are highest, and then unleash your buying power, watch that premium collapse, and of course perhaps spark a rally of that maybe becomes self-perpetuating simply because of the strength. I realize I'm thinking like a criminal here a little bit too much, but I don't think you ever went broke.
Well, we do have
like a criminal.
Well, we do have our poll up before you show your charts that I know you brought. And we asked our viewers if they use sentiment in their analysis. And 41% did say yes. But we do have 11% out there that don't understand, what is sentiment. So it'll be interesting for your presentation, knowing that, about 10% of the people out there aren't really familiar with sentiment.
That's it's actually not surprising. It's sort of an arcane part of technical analysis, but it's useful. I have to say, over the years, I've used it well as a key part of my analysis. Frankly, since I started running the Wall Street Sentiment Survey, which used to be the Fearless Forecaster Sentiment Survey that your dad originated.
Yes.
Erin. And as you go into this business, you're always looking for something that other people aren't doing. Initially, when I looked at sentiment, it was sort of the definition of what other people aren't doing, because I was looking at what people were doing in mass and saying, well, if everybody's doing it, I maybe don't want to be doing that. And that's the classic way of using sentiment. If everybody's bullish, maybe I shouldn't be bullish.
Right.
If everyone's bearish, we should probably be looking for a low. And that's classic for a reason. It works. It's very effective.
Absolutely.
But the nature of sentiment is such that, well, when people are bullish, that doesn't necessarily mean they're wrong all the time. Some of them are right. In fact, some people are smart enough to see a rising trend and know that they want to be with that rising trend. Similarly, sometimes when things are ugly, you want to be out of the market, and you want to stay out of the market, because that extra spike in volatility can be rather painful. So anyway, my first chart here I wanted to look at is the relative VIX, and we were just talking about the VIX and the VXN, and I always want to contextualize sentiment, and what the relative VIX does is it puts it in context with a long-term moving average. And this is a very old indicator. People have been using it for decades and decades. Well, at least 3 decades anyway. As long as I've been in the business, which is about 35 years, people have been using it. It doesn't give a ton of signals, but when you see the relative VIX go above about 1.4 seems to be the magic number. It can be a little lower, a little higher. You can see back here in 2016, we had that spike. We made a low. Market took off, never looked back. We got had a little pullback again early last year. You can see the relative VIX spiked, kind of got close to that buy territory, didn't quite get there. And of course, the market not only took off, but accelerated. But on this last pullback here, when the VIX was so low, you saw a huge explosion in that. And I think, it kind of came to me while we were talking here, but it seems to be kind of reminiscent of what happened in 1987. And I don't want to compare this to 1987 per se, but just conceptually, in 1987, there's a lot of new program trading, portfolio insurance, there was index arbitrage, and having lived through that, it was clear to me that the powers that be in the market were totally unprepared for the implications of all that new technology in trading, and the selling fed on itself, and people who were normally the smart money who knew what to do were kind of caught wrong-footed, and the volatility exploded, and panic ensued. And then when it was done, the world was still, running just fine, and we didn't go into a massive recession, and the market turned around and proceeded to rally on again. That kind of reminds me of what we saw here with the big spike in the VIX. We saw that all those low VIX readings and that explosion in VIX derivatives. I think people were caught wrong-footed. I don't think they were prepared for what that really meant in the marketplace, as big players perhaps were either buying or selling premium and then hedging it and doing other activities in the market that were perhaps non-traditional or unexpected, that really had no meaning whatsoever with regard to perception of value or investment utility, but rather they were just trying to do a program to capture some of that premium or hedge against an further expansion in premium. Whenever you see wild moves like that in the market, that usually there's something amiss. It can be mass margin calls, or it can be something mechanical like this VIX situation. In any case,
Mark, before you go on, we're getting a lot of questions. They're seeing this chart and they want to know what is the relative VIX and how you calculate that.
Okay. What I do is I look at a 200-day moving average of the relative VIX, of the VIX, and then I measure it versus the current VIX reading, and that gives us our relative VIX. It's a rather simple calculation, and it only gives signals, every several months at best. But what it tells you is that when the VIX has spiked enough above that long-term average, there is at least a motive to rally the market and capture some of that excess premium. And that's what we're looking at right now, in fact. It's screaming, we're near a low. We're either at or near a low of some importance, just as it did, back last month. I would, and because things, the VIX panic, has been dealt with. In fact, some of the inverse VIX ETFs have gone away. That to me says we shouldn't expect a reading such as what we had last month. That's an anomaly created by a unique situation. So that really means that these readings up here, we're at 1.78, I believe, if I remember the calculation from last night. It doesn't show on the chart, but we can see we're rather near that 2 level. That's anomalous. You don't see that very often. That to me says we've got big time motivation for a rally of some import here. This isn't a scalpel tool. It could be off by a few days. You can see the last time it spiked before the low hit, and if you bought a little early, you had to take a little heat. You got bailed out, and that's also important. But we should use this as an indicator of there's opportunity here on the long side. Is the low end? Golly, it's hard to call. These are always tricky. I think it's the type of environment where you look at all your indicators and see if you get a clue from them as to what the next direction is going to be. Any other questions on the VIX?
Nope, that was the main one. Yep, that was pretty much the main question: how to calculate it and what it was.
Yeah, I have one other comment maybe to add there, Mark.
Sure.
And that would be, I agree with you. I think when the volatility index, the VIX, the VXN, reaches certain levels, that's when I start looking for a reversal. The problem is that sometimes you're a day or two off, and when you're in a panicked market like we are now, 1 or 2 days can mean a lot in terms of percentage. So have you done some kind of a study where you look at a reading on the relative VIX and then see maybe 10 days out or 15 days out what the market has done? Because it's hard to catch that exact bottom,
Sure.
when the market is panicked and fearful. And I know, because I trade, sometimes it makes it really tough to, even though the market might be getting close to a bottom, you don't want to jump in right in front of that freight train and get run over right before it bottoms the next day. You know what I mean?
Oh,
So
absolutely.
I'm wondering if you've done
Though I will tell you that usually that fear of the further downside is usually disproportionate to the actual pain you have to suffer. If you're early, you only have to suffer through a couple days. Now, if you've got stops in there, that's a very real risk. And yes, we do need to be mindful. Now, in the past, I've done some studies, but I've found that it's more of a window of opportunity, and it's usually 4 or 5 days. It's not a big window. I feel like we don't get enough important signals to have a strong statistical confidence level about how much time you have to wait. In fact, I fear that if we use that alone, we could find ourselves finding excuses not to be buying when in fact we should be buying. Because there's no rule that says it has to go 4 days to a low. It might be the day it hits that 1.4 that the market turns, or it might be day 4. It's hard to know, or it could be day 5 either. These things, you can get a fair amount of volatility and variability. So what we need to do is look at other tools, and I think you're doing exactly the right thing by looking at looking for a reversal bar. We didn't used to be able to trade VIX. I guess you can trade VIX now, but I used to say you don't trade the VIX, you trade the S&P or the market. So what you want to do is you want to look at a chart of the market and see what that's telling us. And I'm just going to jump ahead and grab a chart that we can look at to give us a view of the market. This is an AIM, but what's important is the chart action you're seeing. You see that big down spike, and then that big huge rally, and then a retracement of that. That's your heads up that maybe we're making a low of some sort. Now that final stick is going to be your confirmation. That will give you a lot more confidence in that low. The one you were looking for, that nice big reversal stick, that's where your confidence is highest. It also means almost assuredly you're going to have to leave some on the table. That's usually the price of confirmation. And I've, as a trader, I'm emotionally inclined to want to have that confirmation. But I've been at it long enough to know that I've rarely paid much of a price for picking my spot and just jumping in before that confirmation occurs. I don't need to jump in all the way either. I can just put a small position on and then add to it as well in case I'm early. And I don't sweat that too much when we get those big high VIX readings, because I know we're not too far from that low. We're not going to have to suffer too long. It's much better to be early picking a market low than it is to be early picking a market top. Anybody who's been at this a while knows how absolutely painful it can be when you see this beautiful top setup and then the darn thing just turns around and just keeps rallying another 10, 15%. But much as we saw most of last year, or all of last year, really. The cost, our job as investors is generally getting into the market. Getting out of the market can be hugely useful, but that that requires a good deal of, I think, patience and confirmation. Whereas getting into a low, well, we're rewarded sometimes handsomely for being in there at the very early parts of a low. You can be up 3-4%, 5% even before you get much confirmation, and that's that can be half your for a money manager, that can be half your performance for the year. And if, for instance, you were in a leverage position, well, heck, you've got to jump on everybody if you got in early on. You don't want to be too leveraged, obviously, when you're picking a bottom. And personally, I think it's imprudent, but certainly if you're in there trading, I think you can be well rewarded for waiting only for the proper pattern. I think we're currently in a pattern that's very indicative of low. I think we're within days, if the low might not. I mean, low could actually already be in as we speak. It's just one of those things. It would be neat if we tested those lows down there, as you mentioned before. That would be a very nice pattern, especially if they held and we had a reversal stick. The Elliott wave, people might expect it to go a little lower than that. Even within that context, I think we can have so much confidence in a greater rally because of where the relative VIX is and where the fear and greed index is, that there's a lot of fuel for a rally in here, and that rally could be rather significant. I pulled up CNN's Fear and Greed Index here. This is also not a scalpel-like tool, but it does give you a pretty good idea of where the sentiment is. You don't get much more fear in the market than what you've got right now, and it's not like it was near the top where we were showing extreme greed. This is kind of a confirmation. They look at some of the same things we do, but also some different things. But that's a nice confirmation to know that this is a zone where we should be looking for a low of some sort. We don't have to be that good, I don't think, to pick that absolute low. We want to get in there in the general zone. If you're a little bit risk averse, you can wait for that upturn, that nice reversal stick. That'll lend a lot of confidence to your buying. I too believe that we're in a bull market. My indicators, I like to look at some long-term charts. My weekly charts are saying we're still in a bull. It's still acting like a bull. We're still technically in a correction, certainly, but all the context is we're in a bull. We're likely to get bailed out if we are early, and there's a lot of motive for people to take the stocks higher in here, in the near term. So, the odds, the wind is sort of at our back for the bulls. I do want to mention the commercial paper situation. Now, I view this as sort of a measure of smart money sentiment. The people who are lending money to financial institutions versus the people who are lending money to non-financial institutions. The people who are lending big money to large desirers of capital, if you will, big companies, they're going to know the business pretty well. They're not getting a whole lot of return on that money, so they don't want to be kicking a hornet's nest or buying a pig in a poke. They want to have good familiarity with the business. So I like to look at whether or not people are demanding a little bit more of a premium to lend money to financial institutions versus non-financial institutions. Financial institutions tend to have more leverage, so they're more of a indicator of of health of the financial sector in general. And if the economy is going into trouble, it'll oftentimes show up as trouble in the financial sector. Also, if the market's going to get creamed, it'll also show up as additional risk, perceived risk in the financial sector. Recently, we saw a relative spike in the premium for financial commercial paper versus non-financial commercial paper. You can see we got up north of 0.3. We hadn't seen that since 2016. I view that as an early hint of concern. The last time we saw much of that type of concern was back when there were a lot of fears about Brexit, and the uncertainty in the financial markets related to that was certainly reasonable. And we saw that that concern passed, and the commercial paper differential actually went negative. When it goes negative, that means that there's people are actually demanding less of a premium for financial commercial paper versus non-financial commercial paper. I view that as a general positive sign. And when it's generally low, I consider that indicating a generally benign environment. Certainly an environment where you're not going to get blindsided by a bunch of banks going belly up, or a major brokerage outfit having problems. And so the spike that we saw a few weeks ago, that was a cause for minor concern, but the drop we saw yesterday, actually the day before yesterday, to negative number, indicates to me that we should be looking for some higher prices in here. That says that whatever they're worried about, they're not real worried about it currently. Is that a screaming buy? Absolutely not. That drop is a short-term indication. It's good news in general. It's what we want to see, particularly after a period of increased concern. But in this context, it certainly gives us more confidence about the next day or so, and it's a move in the right direction, implying that perhaps they're done being concerned about the financial sector. In any case, this little blip we saw up is far smaller than we saw up back when we were worried about Brexit. And if you go back to our last bear market, after the the financial crisis, you can see they had readings as high as looks like 2 or close to 2 on that, meaning there's 200 basis points more they're demanding for financial commercial paper yields versus non-financial commercial paper. It showed, and what's useful to us is that concern showed in the marketplace in the summer of 07, where you saw readings north of 0.4, several of them. As we went into that top in October, we were seeing a lot of high readings, far higher than we are now. That's what we want to be afraid of. If we see that sort of thing, you start paying close attention to your sell signals. That means that there's something's seriously wrong someplace. We don't know what it is. The smart money guys do. Let's let the devil take the hindmost. Currently, we're nowhere near those levels, so I'm not at all concerned about a major bear market being promulgated by some sort of problem in the financial markets. It can happen, certainly, but it's very unlikely in the current context. And of course, something else could be a problem for the market as well. But given what we've seen in the current sentiment, I don't think that that's going to be the case. I think we have to give the bull market the benefit of the doubt. One of the other things we look at is the sentiment of active investors over at NAAIM. I like to see big shifts there, either in or out of the market, as something to perhaps trigger some buying. At the last low back in February, we saw a big drop in exposure, and that was the first buy signal we'd had in over a year and a half. It was spot on. It basically picked the low. I have the arrow a little bit left of the low, but that was the day before when the signal came. That was that night, and so the soonest you could buy was at the low, essentially, if anybody was that clever. And you can see it paid off handsomely. Now, we haven't seen that type of drop in exposure currently, but these guys over at NAIM they aren't dumb money. They're pretty smart investors, and they're heavily long the entire rally up. So I'm not. I wouldn't want to fade them just because they're bullish. I only view it as an indication of perhaps some uneconomic buying or selling when I see a big shift. Something that might be exploited by some smart money guys. Other than that, I don't. I wouldn't want to fade these guys just because they're 90 or 100% long. That'd be a great way to lose money, I think, in general. Near term this morning, I was looking at our sentiment polls on Fearless Forecasters, and Traders Talk is where we keep the Fearless Forecaster message board. These guys are all fairly sophisticated traders. They are uncanny at being positioned pretty much on the right side of things at major turns. So at a low, I would expect a lot of those guys to be long. At a high, I would expect a lot of these guys to be short. It's not necessarily a signal by itself. It's sort of an anti-signal. So if none of these guys were long as the market's making new lows, I would not be inclined to be looking for a low. However, this morning, these guys were heavily long. In fact, I think about 62, if memory serves, 62% of them were long. And bear in mind, these are traders. They change their position, oftentimes intraday. But they gave me a tipping point buy where they were 400% more fully long than they were fully short. That's both a short-term buy signal, which in current volatility probably means a little bit less, but also it means that they're heavily long. That's what I want to see if I'm trying to pick a low. And when we see these big red and green bars stacked next to each other, that's kind of that multi-swing action is kind of what I want to see at a low as well. So at the very least, we've got a decent possibility of a low, and it's confirmed as a possibility by the fully long, fully short indicator here, which we keep. And by the way, this is available to the public. You can come on traderstalk.com and check out the Fearless Forecaster message board. The polls are posted at the top of the board. I run them every night through the morning till 9:15. and that's available to the public free of charge. You can use it in your work as you see fit. I would advise only using it as a measure for daily trading. Nothing. It doesn't really imply much over the long term, but short term it can be quite useful. It can give you a nice edge. Obviously, I wouldn't expect it to predict moves of more than, say, 20 points or something like that. But short term, that can be quite useful for those who trade that actively. The other tool we look at here is our options oscillator, which is derived from the ISEE data. This has been a pretty good tool. You can see the signals have been, they paid off. It's a 1-2 day window. You saw the sell signal. You can see the sell signal here from last night. We did get some weakness today. That's not unexpected at all in the type of market we're in. This tool isn't going to be your tool to pick a market low, but in a major correction, of course. But from day to day, within an established trend, it can be quite useful. It'll give you a little more confidence anyway when you're trying to pick your spot. For instance, I'm not sure I would be in there today wanting to pick my low. I would, with that sell signal there, I would acknowledge that we could have a low, but there's also downside here. Of course, we had enough downside probably to fulfill the sell signal for that as well. But I would love to have a buy signal from the options oscillator, rather than a sell signal. If I was going to be stepping out in front of the market and saying I'm going to start buying here, pick a low, and take my chances. Again, if we saw that reversal stick that Tom was looking for, I think that'd be perfectly, it'd be perfectly okay to ignore the options oscillator sell.
Well, this looks great. I mean, I know I talk about sentiment a lot, and I've looked at the name exposure charts and shown those as well during our sentiment. So I've already got people saying, "Can you add these charts?" So I know that no, I can't add these charts. Unfortunately, guys, you need to talk to Mark on his website about getting this information, I'm guessing.
Yeah, and if you want to see what it looks like on a daily basis, I get into this stuff pretty heavily. So, I'm looking at this every day, every night, and every morning. So if you want to take a look at the newsletter, so folks should feel free to stop by wallstreetsentiment.com. I'll give you 2-3 week. I'll add a week to the normal trial, so you can get a good hard look at it. Especially in this environment, it might be useful to see how sentiment behaves as we're trying to form some sort of a bottom, either successfully or unsuccessfully. I think it'll be successful, but that remains to be proven, I guess, at the moment. But yeah, I think NAIM is extremely useful particularly when you see volatile shifts in that sentiment. Similarly, ISEE can be very useful as well. When you see that, and when you see derivatives of ISEE showing big shifts, which is what I like to look at, is big shifts in sentiment. When you see big shifts to the long side, that's oftentimes a fade, at least very short term for a day or maybe a day and a half.
Well, Mark, I really hate to cut you off. I really, really do, and I know our viewers a lot of times get kind of irritated with us when we do, but there's a lot of information there that you've presented, and you do have the trial offer there. So I think it would be excellent. And also, yeah, you do write for the Top Advisors Corner here on Stock.
Yeah, I do. It's a pleasure to do so. And thanks for having me on here. It's nice to be able to talk about all this stuff and have people pretend it's interesting to them.
I think it is. I think they would agree. We have lots of viewers, and that tells me they are very interested in this sort of thing.
And a big part of the market is psychologically, the psychological side, where you have to make those emotional decisions to buy and sell. And sometimes, the buy side, it's like you hesitate. Sometimes it's too long. You wait, the market reverses, and then you're like, okay, now I got to chase it to the upside. Whereas on the other side, you're actually losing money. One is you've got maybe an opportunity cost if you're trying to get in the market and you haven't gotten in yet. But the other side, when you're in the market and it's going down, it really wears on you from a mental perspective. So I think looking at the sentiment side of things, I think does give you the confidence. I think some of the charts that you showed earlier, Mark, especially the relative VIX chart, I thought was really interesting. Where when it gets above its moving average by a certain amount, that a lot of times that will coincide with a market bottom, or at least one's coming. So it is a weapon that you should have as part of your arsenal if you trade the stock market. And I thought your information was very compelling.
Well, thanks a lot, Tom.
Yep, and I will send you chat room questions. If you've put your email in your profile on the chat in the chat room, we will send your questions to Mark, and hopefully he'll be able to get back to them.
I'll get right on it, in fact.
Well, thanks again, and I guess Tom, we might as well get this 10 and 10 started.
Yeah, it was definitely a real pleasure having you, Mark, and we look forward to getting you back.
Yep. I think he's disappeared. So I do love hearing all about that, the sentiment, of course, because it was one thing that Carl did do a lot of. So
yep.
All righty. Well, let's get you. Let me go ahead and I'll share the screen here and show everybody what we requested. I think I got them all in. We ended up with only 30 today. Last time it was like 38, 40 of them. So I was going to go ahead and show everybody the RRG just to get an idea of not necessarily the spaghetti over there in the middle, but just where we're seeing the strength and where we're seeing the weakness and where we're seeing some improvement. So we'll be looking at that. I will be trying to take a few different sectors as I go through, and we'll start off with the Roku. Oh, please do like symbol requests in the chat room because the most popular one will hit the 10 and 10.
All right, let's take a look first at Roku. I did annotate, and there's a bunch of lines on this chart because I'm not quite sure exactly how far this thing's going to go down. It's been in a downtrend since we essentially had a double top up here at about 57.5. But we are all the way back down to 32. I think we'll probably find a bottom here in the near term, sooner rather than later. But the areas, the levels that I would be watching, this was a huge move up back in November. And look at the volume that came in on that move. And then we put in a reversing candle on very heavy volume and made a gap down here to about 34.5. And all the way across here, that was holding until we got into the middle of March. And now it started breaking down. The volume, you can see, though, is much less than what we saw on the way up. So I'm looking for something that's going to suggest a reversal. Maybe it's a tail below a couple key support levels, and then we come back up and close above. Maybe this continues to meander its way all the way back down. I think this is a major, major support level down here, 24.5, and that is still another $7.50 away. But Roku overall for me, I would just be watching it. I'm not interested in jumping in at this point, but these levels are interesting, and if you get reversing candles, that might be that may set up a short-term trade.
All right, excellent. Let's go ahead. I will save the most popular for the next one, give you guys time to vote some more. Let's go ahead and do BlackBerry, BB. We haven't looked at that, I don't think, in a while.
Now, they reported earnings. They came out. They did beat top line. They beat bottom line. And the market, you can see, really doesn't care. We got a gap up at the open, but we have seen selling since. And we talk about this a lot. Most companies, when they gap higher, for whatever news, they tend to go back and at least fill the gap. We've actually done more than that. We've gone back down below yesterday's close and broken into new lows. And given the overall market, just the state of volatility and so forth, this is one I would maybe keep on my radar, but I'm not overly excited about it. I think this action the last 2 days, in my opinion, does take out a key support, trend line support anyway. And so drawing the lines from those recent lows up through here, you can see that we're on the verge. If we haven't broken it, we're potentially on the verge of breaking this. And check out the volume today with the earnings coming out. It's going to be a big volume day. So I'd like to see a reversal in BlackBerry. If it continues selling off today, to me, short term, it's a sell. And I would be looking maybe for a test of support down at the recent low, just below 1150 there, or possibly even down to the reaction low at about 1115 that we saw in late 2017. So this is an area you can see that long tail and the reversal. Mark had mentioned some of these candlesticks. That kind of reversal is what I'd be looking for at a key support level on BlackBerry.
All right, excellent. And the winner is Amazon. That was our most popular request.
Well, I will say this. If you've been sitting back saying, I need a pullback on Amazon to enter, well, you've gotten it. I mean, the stock was over 1,600 a couple of weeks ago. Earlier today, it went down under 1,400. That's a huge drop on Amazon. And I think if we go back and look over the last few years on this weekly chart, you're going to see there haven't been too many tests of that 20-week moving average. We almost did that earlier today. This has been one of the best stocks in the market. Again, there's no guarantee that it goes higher, but generally speaking, pullbacks in Amazon have represented pretty good opportunities. So I would simply, on this long-term weekly chart, just simply mark the rising 20-week moving average. I think if we get down there, that would be an interesting area, just given its history of holding that 20-week moving average. I mean, we really haven't seen much of a breakdown over the last 3 years. We did at the beginning of 2016 have a little bit more weakness, but that did come here with higher prices, false breakout, and a negative divergence. I don't see the negative divergence here. In fact, the weekly PPO has been rising over the past several months, and so normally when you get that type of environment, a pullback to the rising 20-week moving average is a great entry.
All right. See, the next one I have for you is Smuckers, and that is SJM.
All right, let's see. That is well, I guess maybe this isn't a bad way to look at the chart, just because, you know, when you look at the longer term weekly chart, we had a nice uptrend for a while. Mostly the rising 20-week moving average was holding, but since then it's been mostly downside. And on the more recent, the last 3 or 4 months, it looks like we've started a nice uptrend, really nice hammer on that 20-week moving average. We got a golden cross. I would probably be okay with this one as long as it doesn't violate that prior low. So right here, if you lose that price support on a weekly basis, then you're going to be closing back down below the 20 and giving up price support. You do have this double top in here. So we didn't get a breakout. So I'd really like to see this become more sideways consolidation as opposed to a breakdown. So watch about 117, 118 to the downside on JM Smucker.
All right. The next one I have is, let's see, Marvell, MRVL.
Yeah, here on the weekly chart again, this one I think looks pretty solid. We do have a negative divergence that developed. So let's annotate that quickly. I always like to use the pink, but here you've got higher prices coming across here a couple of times. And from here, though, is where we got that negative divergence on the second high. So it's really, I could probably get rid of that one, actually. And let's just go with this high right here. So there's your higher price, lower PPO, and right on the top there is a bearish engulfing candle. So you got a reversing candle on a weekly chart with a negative divergence. That normally means 50-week test. The 50-week test kind of comes in the middle of some key support. There's the top of gap support. There's the bottom of gap support, and you got the 50 right in between. So I would be looking for Marvell to find some support somewhere between about 18.5 and 20, and we're at 20.71. Recent high was up near 25. So as you get down closer to 20, I think your reward to risk here starts to look pretty good.
All righty. Let's see, next one will be MTOR, Meritor, commercial vehicles.
Yeah, I was actually, this is one stock a few weeks ago I got stopped out of. Maybe it's been a month. But this was a key area up in here. I was looking. This was an earnings-related move to the upside, by the way. They beat top line, beat bottom line. I thought the pullback into this 25.5, 26 area was going to be strong, and it ended up getting stopped out. And this is why you use stops, by the way, because the stock has just continued going down with hardly any bounce in it whatsoever. The PPO continues to move lower. I think eventually we'll probably get a 20-week test. But that for me would probably be, it would be a sell signal unless we can get a close above it. So I would be watching at some point for a little bit of strength, maybe to test that falling 20-day moving average, but that's about as much as I would look for there. I think if we show the price support here, The breakdown, we came back up here, tested it, couldn't get through. 2250 is going to be a wall of resistance.
Okay. Let's see, next one is Stepline Therapeutics, STML.
All right, STML. Well, we're coming up and testing both of these moving averages. We've already fallen off of the high earlier, so I would be careful if we weaken into the close today. I don't want to leave a tail up above both moving averages like we did yesterday. But first, I would just kind of circle this area because you've got both moving averages right in here. I think also recent lows right here that you broke below on heavy volume. We've gotten up through that, which is good, but you can see the volume was much lighter on the move through than what we saw on the way down. So failure here at the moving averages would concern me. The longer term price support that we've tested many, many times, just did it a couple of weeks ago, is down around 1340. I think today's close is going to be important for the stock. Of failure and reversal, close down near the low or in the lower half of this candle would probably suggest a top is in near term.
All righty. I have next for you RH. Home Improvement Retailers, RH.
Yeah, RH, that's Restoration Hardware. And that stock, actually, I'm trying to go through my notes here because they did report they missed on their top line and they beat on their bottom line. The stock, obviously, the market likes it, though. We are still in kind of a longer-term sideways consolidation, but I think we cleared a key area of resistance on the open today, and that gives me makes me feel a little bit good about things here. That was the double bottom that we broke down back at the end of February, early March. Here was a gap support zone right here where we had closed before we opened up on massive volume. So that's a key area of support and also resistance. And look at today's gap. We actually moved above both of those. I wouldn't want to chase. Certainly in this market, wouldn't want to buy something that's up 22% today. But this is one that's probably worth watching. And if it were to break back down into this zone, especially with a reversing candle, could be buyable down the road. One last comment. Notice as we kept moving down right before earnings with the lower prices, we did see the PPO rising. So there was a little bit of a positive divergence in play. Market liked the earnings report that came out. And so it looks to me like now it is beginning an uptrend, but I'd have to wait for some weakness to enter.
Okay, we have two more. Goldman Sachs, GS.
Yeah, Goldman Sachs, along with all the financials, are going to struggle as long as the 10-year Treasury yield continues to be down. Now, I don't think that the movement down in the 10-year Treasury yield is going to last, but I do think short-term it could go a bit lower. And so I would watch on a support basis the February low here on Goldman Sachs. I think as long as we continue to hold around 244, today's low was 244.37, I'd be okay with it. To the upside, let's see how Goldman Sachs reacts if it hits its 20-day moving average. If it fails, then I think you continue to be mired in a short-term downtrend. So for me right now, the trading range is, I'd even go down to maybe 243 on the low side and 258 top side.
Okay. And last one is Carnival Corp, CCL.
All right, CCL. I'll tell you what, for the last one, why don't we do the, I like to do that relative chart on at least one of these. First of all, I think it's pretty clear that you got a couple of key support levels on CCL that we want to keep an eye on. The more recent lows, I would say, are right about there. The low that we had just a few days ago, you can see all of these tails coming down. Here was an open. If you get below 64, you're taking out support from the last 4 or 5 months. And then that would open up a potential move down closer to 62. The volume you can see has been picking up on this movement to the downside. And you can see the overall group has moved to a multi-month low as well. So you got a few warning signs here that this stock is actually holding up pretty well in March relative to the group, which has been going down much faster. But you can see relative to the S&P 500, this is a stock that topped several months ago, and its peers relative to the S&P 500 are actually near a one-year low. So there's a lot of mixed signals here. It's not going to be one of my favorites. I personally would pass on this one unless I saw something, some sort of reversing candle at one of these key support levels. Then it might become a short-term trade.
Excellent. And that completes the 10 in 10 to 1. And the symbols are up on there so that you can see what we covered. I will get those to you pretty much after the show. They should be up in the Market Watchers Live chart list, which you can get to by going to the Market Watchers Live blog. The link is right at the top. And with that, I think it is time to do our talk about ChartCon. And you'll see the link there, just a moment. And I am going to get my screen up here. So, all right. Yes, reducing risk in uncharted waters. We're going to be in Seattle doing the ChartCon this year, but you can go from the seat in your house, wherever is most comfortable, in front of your screen, and join us. And we have a huge list of guests. It's 2 days, and you will get all of the recordings as well when it's over. So I think all of you out there, I've said this pretty much every time we've done this little talk. I would expect all of our viewers to be in attendance online, since you're always in attendance here for our show. And I know you're pretty excited about it too, Tom.
Yeah, it's always great getting together with everyone. And for those of you who are unfamiliar with ChartCon, this is an every other year conference. So there's not going to be another chance for 2 more years to listen to everyone's talk, and especially the topic this year being about risk. As I said before, that's really the most important thing for me anyway as a trader, is managing risk. And to have all of these experienced analysts come together and talk about risk, I think is kind of a once in a lifetime kind of a opportunity.
Absolutely. And if you do want to join us in person, I believe that we're going to be, the deadline is actually Friday to purchase a VIP package. You can come for just the weekend while we do our presentations, or you can also join us on the cruise afterwards. So think about it, but you don't have too much more time to think about it because it is on Friday. So
Cruise with the crew.
Yes, it'll be great. I can't wait. I'm very excited. And with that, I think we'll go into our market update, the final one. I'll make it pretty quick. And here we go. I want to make sure that I do have the most recent data for all of you. So ultimately, you know, the really big decline occurred yesterday, and we've been really consolidating mostly sideways right now. I think everybody's too nervous to really jump in, but they're also not fearful enough to get out. So I think this shows a lot of the indecision that we're experiencing right now. And you can see technology is down a bit, NASDAQ is a bit lower, but Russell 2000, most of the major indexes are mostly unchanged. See Treasury yields are down. Also, don't want to forget our friends in Canada. The TSX down slightly. We have the Treasury yields, like I said, down today, but are making their way back up, reading at 2.773. UUP, big gap up and now consolidating sideways. And you can see commodities are lower. Also, USO likely affecting that, hitting a low at 1285 today, but currently reading at 1290. Gold, big gap down and has continued lower rather than consolidating sideways like we're seeing in the dollar. And that was something I wanted to just point out. Are we looking at gold going down simply because of what's going on with the dollar? Well, currently, if you go to kitco.com, they tell you, did it really go up or down? And as you can see, the price due to the strengthening or weakening of the dollar is only this amount, this portion. So more than half the change is due to predominant sellers. So that I find interesting, and it probably could give us a little bit of a sigh of relief in a way, because generally when gold starts to fail, the market starts to do a bit better, with gold being usually the choice for a safe haven in rough waters. And with that, I'm going to close out the final market update. Did you have anything you wanted to add, though, to that, Tom?
No, I think I'm probably pretty good. I will just say, you know, that the NASDAQ has retreated a little bit more. NASDAQ is now down 37. So it had snuck into positive territory right after we opened the show. but it has turned back down now, down 37 points. And again, that seems to be the weakest area right now. So still looking for a reversal there.
All right. Sounds good. Well, I guess we should go ahead and get into our scooter reports today. And I have a screen, so I can give it a start.
Sure.
All right. I'm going to start at the sector summary. Can you see my? Yes, you can. Just
Yep.
making sure my screen is up. Excellent. Okay, so what I did is pulled up the sector summary, and you can do this right from the home page. I will get back to there. Well, let's just do it this way. You can go right here, and beside our scooter reports, we have our sector summary. This is part of the scooter report that I'm going to give. I wanted to concentrate a bit more on the sectors and the rotation that we are kind of seeing going on right now. So this is a 6-month period, and clearly we can see cyclicals and technology, all of those aggressive sectors leading by quite a bit. And if you do go by scooter ranking, really no change in how we're set up here, with materials really low, and you can see staples also struggling. What I found interesting is that utilities are sort of making their way back up the chart. So if you go to the 3-month, we're still looking at a very similar situation. I'm going to go by price change here. You're still seeing cyclicals and technology leading. And what I find interesting, though, is when you get to the 1 month and the 1 week, you can see we really are starting to see movement into, especially the utility sector fund, XLU. And you can see its scooter value has been moving up from 30. I'm going to actually show you this chart so you can see utilities, and I'm going to pass it back to Tom. So right now you're looking at the spider. And what I wanted to point out was, from looking at that report, this is something that worries me. When you're looking at a very defensive area of the market in utilities, and we're seeing this sort of a move in the scooter, that kind of relative strength coming in for the utilities, I think that's something to be a little concerned about. But at the same time, if you want to stay bullish about things, if you come in here and you can draw, we don't need the arrow, a rising wedge, and those are bearish patterns, and the expectation would be breakdown from this wedge. So I think at this point, we're going to get a lot of information, honestly, by market behavior, obviously from that, but looking at also the utility sector and seeing whether we're going to get a breakdown. Is this pattern going to execute, or are we going to get a breakout, a move, a bullish conclusion to a bearish pattern? And that would be extraordinarily bullish, in my opinion, for the utility sector. And with that, Tom, I'm going to pass it over to you as far as our scooters and what you're seeing.
Okay, well, I'm going to focus today on the NASDAQ 100 because we have been seeing a lot of weakness. We can see the weakness picking up again today. So I wanted to look at the NASDAQ 100 stocks. And I wanted to show you first how you can use stock charts to set up these NASDAQ 100 stocks in a chart list. It's really easy. Rather than trying to figure out what stocks are in the NASDAQ 100 and then pulling up the stocks individually and adding your scooter, I'm going to show you how you can do this pretty quickly. So from your member dashboard, now I already went down here and clicked on Add New List, and you can see right here I just typed in NASDAQ 100 and I don't have anything in there right now. So all you would have to do first is click on this and type in whatever you want to call it. So I've already done that, so I'm not going to do it again. That's this NASDAQ 100 chart list. And then under your scans, one thing you can do, create a new scan, and under indexes and ETFs, if you go down here to the NASDAQ 100 and just click add, now there is a filter in here. You want to make sure you have volume over 40,000, but that's not an issue with NASDAQ 100 stocks. So if I run this scan, you will see 100 stocks just came back in this scan. And then under available actions, I can say revert or replace an existing chart list with these results. And then I scroll down, there's my NASDAQ 100, and boom, okay. Now I just have a chart list with these 100 stocks. Now I can quickly click on the scooter, and this will tell me, it now gives me in order the NASDAQ 100 stocks ranked by scooter. So it's, I mean, how long did that take me? A minute, maybe 45 seconds? I don't know. But it's very, very quick. And then what I thought maybe we would do is take a look at some of the ones on the bottom. And I got to tell you, this is kind of funny. And I don't know if it was meant to be funny or not, but I went through, I tell you, we read all of our survey responses, but I did get a comment from someone who, and it said, Tom, you still like trying to catch those falling refrigerators from the 10th floor. Tesla with a big, huge exclamation point.
Indeed.
And I have to say, I am actually looking at Tesla. I would love to see a reversal on Tesla. I don't own Tesla right now, but I have been looking. And thankfully, Arthur told me to stay out of it yesterday morning before we got into the before we started the show. And I think Tesla has fallen probably another $40 since then. I mean, it was closer to 300, maybe 295 or something. But anyway, let's take a look at the chart of Tesla. And first of all, I've got this coming up in a 6-month chart. That's my default on this particular account. And you can see there's nothing really to like here. We had a big breakdown on heavy volume, continuing movement down here on even heavier volume today. Tesla's under a lot of selling pressure. The PPO looks horrible. What could I possibly like? Well, if you go into a weekly chart on Tesla, prior to this candle, when I was looking at it yesterday, when it was at about 295, you can see that there was a double top that we had broken out above, and the breakout was at 280. And so this is a longer term chart. So looking at a pullback while it was sitting at 295, I was thinking, okay, well, maybe 280 would be a good area. Well, at this point, we've now broken below support. So I'm not really interested until I see a reversing candle. But that is why I was interested in Tesla. It wasn't so much that I want to try to buy a stock that's a falling knife, or in this case, a falling refrigerator, especially from the 10th floor. Actually, if a stock is on the 10th floor and that refrigerator drops, I'll try to catch it around the 8th floor, but I don't want to catch it on the 5th or 6th floor. To me, it's fallen too far at that point. And you know, it just gets heavier the further it falls. But anyway, that's a look at Tesla. Don't want to save that. But from that list, and I think it was right here, yeah, we can go in and take a look. These are the scooter ranks, so you can see which stocks among the NASDAQ 100 have been performing horribly. We just looked at Tesla. You could see the weakness on the chart. Let's take a look at Dish Network, DISH. I think it's pretty easy to see this is not a very good-looking chart. And we could go right down the list. Celgene, not a good-looking chart. Let's take a look at KHC, Kraft. Here we got
nice reverse flag.
yeah. We got a reverse flag, bear flag here in play, and that's after a pretty significant downtrend. Now, there might be some reasons to buy the stock from a value perspective. Stock was $80 back at the end of January. Now it's $60. So there's probably some say, hey, that's a 25% haircut. This is pretty nice looking, potential stock to buy from a long-term perspective. It's a great company. And that may be true, but it's from a short-term trading perspective, I want to see something that's got positive momentum. And that's certainly not what we're seeing here with Kraft. Dentsply, which is ticker symbol XRAY. I love this ticker. But anyway, this one's down. You can kind of get a feel why these stocks have scooter ranks in the single digits. I don't think it's this isn't rocket science. This is just a quick, it is exclusive to stock charts, these stock charts technical ranks, and it was developed by John Murphy. So right there, I think it gives you a lot of credibility. But Insight, here's the next one, and you can see again down. So just a quick look at these scooter ranks. Most of the time, when you see stocks with scooter ranks below, in the lower half, really, but especially in single digits, they're probably not stocks that you're going to want to just hang on to and, sock them away and walk away from the market for 2 months, because you may not like the surprise you see when you come back, because they are downtrending. And haven't seen anything yet in those stocks I just showed that would suggest that they are healthy or about to turn healthy. Now, on the other hand, let's take a look at the top of the list. For those of you unfamiliar with the scooters, they go from 0 to 100. And when you get scooter ranks up in the 99s, anywhere in the 90s, really, what you're looking at are stocks that have been outperforming their peers within that market cap group. So large caps are pitted against large cap stocks, mid caps against other mid cap stocks, and so forth. So you can see here, Seagate Technology, technology company in computer hardware space, scooter rank at 99.7. I can tell you without even looking at the chart, this is going to be a completely different looking chart than what we just looked at. And here you can see it's going the other way. So one of the screens that you can use when you're looking at stock charts to find stocks that are actually performing well is simply to go to the scooter ranks. Now, I just did it in, looking at the NASDAQ 100 and pulling it up in a list, a chart list. And now I can go back, by the way, and I can look at that list anytime. It's already been saved into a chart list, which is part of the organization that you really need as a trader. But if you want to just look at all stocks in the universe, you can come down here and look at the scooter reports right on the member dashboard. Here's your large cap, and here are the 99s on down. There's Netflix. So you'll see a lot. There's Seagate. These are two stocks that are in the NASDAQ 100. These others are not in the NASDAQ 100, Echo Patrol, XL Group, but yet they have very strong ratings as well. And this one's in energy, which is amazing that any stock in energy is 0.9. But
I know how much you love that sector.
Yeah, actually, I actually started liking energy quite a bit, but it's reversed and kind of gone back down. Crude oil has been going up. I could talk about that for a while, but I mean, look at this chart. This doesn't look like the energy chart. Let me show you the XLE. That's the XLE. And then the chart I was just showing you was EC, Echo Patrol. And this to me looks like it's the XLE almost upside down. You got a beautiful move up. This looks like a cup to me. Little handle building on the side. I mean, this is a completely different pattern than what we were looking there. And the way you find a stock like this, again, is by looking at the scooter. That was the way that I came up with this stock. So stock charts does a lot of things. It's powerful. These tools are so powerful. And if you know how to kind of move your way around the site, and like I showed you earlier, how you can run a scan and save it into a chart list. I actually have with you, if you look at my chart list here on this account, I've got the NASDAQ 100 stocks. Here's the S&P 500. You can keep 500 stocks in a chart list. Here, I currently have 500 in this list because it's the S&P 500. You click View All, click on Summary, and this is the last thing I'm going to show you, by the way. We'll wrap up. And here is your scooter rank. So now on the S&P 500, Seagate also is in the S&P. And you can see that it got to be GE down here. Yeah, there's GE sitting at 0.6. Can't believe it's actually past two companies. But anyhow, that is just give you a different way of looking at the scooter and different ways to analyze stocks.
Yeah, and the top rankings, it's not like these guys have just hit the peak, right? That they're topping because, expect them now to go down because they're overbought. It's not really an overbought indicator. It's telling you that these stocks actually have a good batting average, meaning you're probably going to be on the right side of the trade because it does have a high batting average, a high scooter.
Yep, absolutely. I know we've got some great stuff coming up. I think actually tomorrow I'm going to do seasonality, but what else we got coming up, Erin?
Oh, goodness. Well, we have Arthur coming in tomorrow, which is going to be great. And Friday, the market is closed. And then, of course, we're going to be ringing in and kicking off Stock Charts TV on Monday. 24/7 coverage, guys, for you technical analysts out there. It's going to be great, and we're going to be kicking it off on Monday on the show.
Always something exciting going on here at stockcharts.com. I want to thank everybody for being with us today. Remember to complete the survey as you exit. We do love to get your feedback, hear what you think of Market Watchers Live. Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. We'll see you back here on Thursday. Happy trading.